Hello and welcome to this Wednesday's morning market briefing. We've got lots to talk about, but firstly, US job openings dropped to lowest level in more than 2 years, as well as that Brussels proposes 3-year delay to EV sales tariffs between the UK and EU. We've got lots to talk about on the charts, also with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around till you see that. Before we get straight into it, make sure to subscribe. But the first article to talk about, of course, is US job openings. Now, US job openings fell to their lowest level in more than 2 years in October, with this once again reaffirming the notion that the labour market is cooling. Now, we've been covering, of course, the US kind of position with its interest rates, as well as, its labour market as a whole, with the labour market being a clear indicator of where the US economy is heading. And therefore, when we use the labour market, when we look at the statistics in relation to unemployment, or as we hear with this, job openings, we're able to then see how the US Fed may then shape its monetary policy going forward, as it will incorporate, its understanding of the US economy using these figures. And from what we've seen, most recently, with lower levels of inflation than expected, we have seen those kind of expectations for rate cuts come sooner and sooner. With yesterday, I think we spoke about rate cuts being expected even as early as May now, with that being very, very early in comparison to what we were hearing, earlier on, maybe in September, when we were still talking about the Jackson Hole meeting, when we were kind of talking about rates staying higher for longer, with the possibility of rates even going up by 0.25% by the end of this year, and to now see the chance of that being very, very, very minimal, and now we're already talking about those rate cuts, is very significant indeed, with this new information sparking a rally on US bonds, as people then expected lower rates. And so this is adding on to that already quite dovish expectations by many traders. Now, this also further proves the efforts that the efforts by the Fed to lower inflation are in fact working. And whilst we have been hearing from key figures within the Fed, such as Jerome Powell, that rates need to stay where they're at until there's a clearer understanding of how the US is responding to those higher levels of inflation that we've seen over the past 2 years or so. The fact that we're now seeing all of these indicators, present to us the chance that inflation, the high inflation era, is finally ending, is winding up to be something most certainly. With if we do kind of see this continuation, with increasing months ahead of us, presenting the same sort of fact that inflationary pressure is decreasing, the labour market is cooling, the overall economy is kind of slowing down, that's when we're then going to be able to see individuals such as Jerome Powell come out and say it's time to cut rates. So that's what we're thinking of and talking about at the moment. Now, US businesses only advertised 8.7 million job vacancies in October, which is down from 9.6 million in September, with this latest figure being the lowest levels of openings since March of 2021. It also became below economists' predictions of 9.3 million openings, with the demand for labour surging during the pandemic, but have since trended downwards since 2022, with October's drop being triggered by fewer openings in healthcare, financial activities, and the retail sector. So this is what we're really talking about here. Now, of course, we will be getting the US NFP figure coming out by the end of this week on Friday, and that will be really important in reference to this, but also overall in reference to where the Fed may go with its interest rate decisions. Now, we will be getting one more interest rate decision within 2023. that being December's interest rate decision. And so we're kind of looking at that as a time where rates are going to be held steady. As I said at the start, initially some time ago now, actually, we were kind of expecting the Fed to possibly raise rates slightly, but now we are expecting them to stay the same. So it'll be interesting to see what sort of rhetoric we actually hear from that meeting, as I think that will be the most important part of the overall meeting is, will Jerome Powell kind of start to succumb to the idea that inflation has in fact, come down enough to where we can start talking about rate cuts or not. Now, layoffs, however, have remained steady at 1.6 million, and the number of quitting staying at 3.6 million. And this is adding to that evidence that high interest rates are cooling demand, with the US bond yields already being down before the data was even released, following a top ECB official said that further rate rises in Europe were rather unlikely. So we're having this added kind of context to the entire world now, which is the whole world seemingly within these top central banks, are kind of succumbing to the idea that further interest rate rises are very, very unlikely, and already starting to talk about the possibility of rates being cut sooner than previously expected, with the Nasdaq also being up 0.3%, whilst the S&P 500 was flat on the midday. Now, officials will be watching the NFP data release on Friday very, very closely, of course, with the Fed set to keep rates steady at their highs when it meets later this month. So listen out for that NFP figure on Friday. That'll move the markets greatly as people price that into their monetary policy expectations. So definitely listen out for that. But that's all to talk about in reference to this article. Next article to talk about is Brussels proposing that 3-year delay. Now, yesterday, Brussels proposed a 3-year delay to tariffs that were due to hit EV sales, with this providing a big boost to Europe's car makers. Now, in the last kind of 2 months, I would say, a lot of pressure's been on the ECB and the Eurozone as a whole to kind of deal with the increasing issue in relation to Europe's car making industry. Now, we've spoken quite a lot now about Germany's issues within the automobile manufacturing industry, with Germany obviously being a powerhouse and a well-known name within the industry. However, most recently we've actually seen contractions, with this largely being as a result to those higher prices that the producers are having to deal with that being higher energy prices, higher interest rates, and this is all adding on to the ability for these kind of production facilities to run at good levels of efficiency. And so we've heard increasingly from these businesses and business tycoons that they're looking to kind of expand outside the country and possibly even move out of the country, which has kind of worried Brussels in particular, which is why I think we're now starting to hear this kind of rhetoric about not imposing these tariffs which were previously expected. Now, officials at the European Commission would on Wednesday, so today, support the delay of a 10% levy on cars with batteries made outside the UK and EU, with the British government in unison with car makers across Europe having argued for months that the post-Brexit tariff on the industry should be deferred. Now, car makers had warned that the goal of the tariffs, that being to spur the development of the European battery supply chain, would not work as intended. And with the EU now noticing that the UK being the biggest export market for the EU's cars, increasing prices further would only allow Chinese brands to take their place, as increasingly as China grows as a bigger and bigger economy, although they've had their issues at the moment. When we talk about the future of the Europe's car market, you have to consider that the EU will very much be considering the competition, or at least the potential of competition from car makers such as those in China, and therefore they need to kind of adjust their business relationships, especially with large trading partners like the UK, to accommodate for this kind of low price economy for cars across the globe as a result of China growing in this industry. And that's what I think we're now seeing. Now, a qualified majority of the 27 member states must now agree, but with Germany and around 20 other governments in favour, officials believe this is a foregone conclusion. So they believe the decision's already been made, essentially, with Paris initially being skeptical of changes, worrying it would create a precedent that could be exploited by London to argue for other changes to the deal. But ultimately, European car makers have prevailed after warning of a 4.3 billion euro loss whilst facing cuts in production of almost 500,000 electric vehicles between 2024 and 2027. And this is what we were just talking about, is those cuts in production and the risks to the European car making industry. So keep your eyes on this, most definitely, to understand Europe's trading relationships. But that's all to talk about on the articles. Next to talk about, of course, is the charts, with the first asset to talk about, of course, being US indices, in particular that being the US 30. Now, of course, we've seen great US rallies for their assets most recently, and as we spoke about earlier, we've seen an increasing amount of bullish pressure on US assets following increased kind of signs that the Fed's interest rate policy is working as intended, and therefore kind of creating these expectations for rates to be cut sooner than previously expected. And so what we've now seen shape up on the charts is the US 30, that being one of the key US indexes of US stocks, taking a strong move to the upside since around the start of November, but on a more short-term scale, in terms of what's happened yesterday, it does seem that the US 30 has slowed down and almost consolidated, as it was making those serious new highs after breaching above this strong area of liquidity and resistance that we noted. So the question is now, where might price retrace down to, which is why we've drawn out this Fibonacci retracement tool. And if we were looking to see where price may come down to, we could be looking at the 6180, the 50%, or the 3820. So keep your eyes on this. Next to talk about, though, is the dollar, which has continued to push higher. Now, we were initially, maybe a week or two ago, talking about how price was kind of moving down in this bearish channel, but dollar actually has seemingly taken a move to the upside and broken out of this channel that we were previously talking about. Now, we did see that false breakout, so we kind of thought, okay, price is going to remain within this channel, but price did actually end up coming out of the channel in its entirety and taking a significant move to the upside. And what we're seeing right now is that continuation, as we did kind of reference the fact that price was coming into contact with this 78.60 level, so there was a chance that price moved away from that, but price has continued to the upside, so keep this on your radar. Next, talk about, though, still on the topic of the dollar, but Euro USD, of course, where I have highlighted out a significant area on the charts, as price has now broken through this 61.80 level, that we had noted as a Fibonacci level. And it has already broken below, the 38.20, which was another level that we noted, and the 50% level. So if we were to look and see where price may, have to retrace from, as increasingly price is becoming oversold, as you can see here, coming below that 30 point level on the RSI, we could be expecting a significant move away from that 78.60 and liquidity zone that we have mapped out here. And so if I was, looking to see where, price may then have a significant retracement from, maybe move back up to this liquidity level around this 50% Fibonacci area, we could be looking at a move from this level most definitely. Next talk about, though, is pound yen. Not too much to talk about on pound yen. Price is still consolidating, still kind of moving to the downside. But so keep a bit of your eye on pound yen. Next to talk about though is USD JPY. No, not USD JPY. Sorry, but Bitcoin, which has in fact continued to push higher, as you can see here. And this is kind of presenting an increasingly and overwhelmingly bullish kind of picture for Bitcoin as it continues to push higher. Now, yesterday we were talking about the record kind of breaking highs for Bitcoin, tapping that $42,000 mark, but price has continued to move higher from there, and even making its way up to the $44,000 mark. So significant moves on the upside for Bitcoin. And the question is really, will it retrace at some point? We draw now this, Fibonacci retracement tool, just on Monday. And since then, price has already moved so far away from it. And so if we were to draw it out again, maybe price can make its way back down to these levels around the 38.20. But, price has still so much bullish momentum. So it's hard to see where price may then stop off and, come back down. So keep your eyes on this, most definitely. Lastly, to talk about in the charts, though, is gold, which we did talk about yesterday, breaking its all-time highs, with this great level of volatility that we did see. However, price did then kind of return to the downside, and is now breaking below this 78.60 level, which we did initially believe may be the end of the retracement and allow it to take a move once again to the upside. But price has moved below it, so it's hard to see where gold may go from here, but keep your eyes on gold nonetheless. But that's all to talk about on the charts. Lastly, to talk about, of course, is the economic calendar. We do have quite a bit of data coming out today. So firstly, we will be getting Aussie GDP growth rate coming out, along with the Bank of England's Governor Andrew Bailey, of course, having a speech today. So make sure you listen out for that to have a better grasp of UK's monetary policy, as well as that we will be getting British construction data. That's an important one to note as well, to understand how the British economy is doing. As always, listening out to understand how the overall economy is doing allows you to form that monetary policy picture and expectations, as the Bank of England, the Fed, the ECB are all using these figures to determine the future of monetary policy within that nation, which is why we need to keep such a close eye on all this data. We will be also getting Eurozone retail sales data. Obviously, that shapes into the level of consumption within the economy, and therefore, demand side inflationary pressures, so keep your eyes on that. So as that, we will be getting US mortgage applications data being released, along with the US and Canadian balance of trade data, so significant data right there, as well as that. And finally, we will be getting the Bank of Canada's interest rate decision, so a big one for Canada to note most definitely. But that's all from us at Wildwood Capital. We talked a lot about a lot of stuff on the articles, a lot of stuff on the charts, and finally we did cover a lot on the economic calendar. But that's all from us once again. Have a great trading day this Wednesday. See you later. Bye.